What we will be covering today would be through the background and the deep dive of the amendments. The background and the applicability of these amendments is from the date of publication of these uh, amendments in the Gazette of the country. These regulations have been published on the 12th of December 2024, and based on the drafting of the regulations, these amendments come into force from the 12th of December. There are two exceptions, primarily related to quarterly filing. We'll discuss on these exceptions, though they have also come into force from 31st December. So now all the regulations that are in place for equity listed entities have come into place from this date. Some statistics we'd like to share because we have done a deep dive analysis of the amendments. We have analyzed 84 amendments of the total list of amendments that have been carried out by the uh, amendment regulations. 37 of those relate to modification or new requirements. So 37 amendments are there which are relating to new requirements that are applicable to listed entities to comply with. 17 are for the purpose of clarity, so they give some clarity around the existing provisions or the existing intent of the regulator. 12 are consequential, so if there is a modification or a new requirement in one regulation and its repercussion across other regulations is something that is considered as consequential by us. 8 are related to omissions of existing requirements on account of redundancy or for in the manner of relaxation or ease of doing compliances. 4 are for removal of difficulties. So they have removed some difficulty in interpretation and implementation of those regulations. 3 are recommendatory in nature. So they have introduced a few recommendations that are not mandatory, they are recommendatory in nature. And 3 amendments that we have analyzed are relating to the relaxation of the compliance requirements. So coverage, we would be covering in the order of importance that we have assigned to these topics. The first list of topics that we have identified and classified these amendments into is material events and information, primarily around Regulation 30. Newspaper disclosure, because that's a significant amendment that would impact a lot many entities. Amendments around the timelines for disclosure, by when a disclosure has to be made to the stock exchanges. Related party transactions, all the amendments relating to related party transactions would be covered in this section. Directors, board of directors and committees. So there's a lot of changes that is proposed around this section of the compliance requirements, and we'll be covering it in that section. Then there is a concept which is introduced, which is integrated compliance reporting, that we'll cover in the next section, which is the next 5 topics: compliance officer, secretarial audit, website disclosures, and annual report disclosures. As we move towards the third section, we would reduce the coverage of the discussion in the interest of time. We would deep dive into section 1. We'll have medium discussion around section 2, and we'll have a high level review or a high level view of the section 3 amendments that are there. So let's deep dive into it. The first thing that is a significant change that we understand is impacting all listed entities is the investor meets. All or a lot many listed entities host investor meets, and those investor meets are followed with or accompanied with a presentation that is made by the listed entity. Various analysts attend such investor meets, and at these investor meets, there are these presentations that are provided or showcased. And currently, the requirement is also to, or listed entities do share these presentations on the stock exchange. However, the timeline for disclosure is not very clear. So what happens is the assumption or the underlying genesis for this amendment seems to be that the analysts that attend the call are privy to certain information which is before any disclosure happens to the stock exchange. So there can be a timing difference for their advantage for the participants of these investor meets. SEBI has now mandated that entities holding investor meetings need to disclose the presentation that they would be making in the investor meeting prior to the beginning of these events. So before the investor meeting begins, the presentation that is going to be made to the analysts attending these investor meets needs to be disclosed not only to the stock exchange but also hosted on the website of the listed entity. So now going forward, any investor meeting that happens has to be having a prior disclosure of the entire presentation that is going to take place at the investor meeting on the stock exchange and the website of the company. And this requirement is prior to the beginning of such event. So this is an important change because before the beginning of the meeting, the presentation has to be at both these places. Also, an amendment is to have an optionality around the disclosure of names in the schedule of analysts. That's a minor thing, but the primary thing is about the presentation that has to be hosted before the beginning of the event. Another important disclosure around the requirements of Schedule 3 and Regulation 30 is the actions taken or orders passed by any regulatory authority or judicial body. Now, the background is certain disclosures, like in December of 2023, Reliance had made a disclosure that there was a 62,000 rupee penalty levied on Reliance for GST compliances, where the registration of the party whose credit was claimed had been cancelled retrospectively. So for a company like Reliance, an amount of 62,000 is not material. However, because this was a item which did not require applicability of materiality threshold for determining disclosure, this trivial amount was also disclosed to the stock exchange. Similarly, in the case of Sapphire Foods in July of 2023, there was a penalty of 10,000 rupees, which was also disclosed because of not having a dustbin outside the store. And interestingly, Yes Bank had reported in December 2023 a penalty of 150 rupees, which was levied for not handling properly the process of soiled notes. So these disclosures were being made in order to comply with the regulation, which did not have any materiality threshold to be applied for disclosure. Now, this led to an unintended disclosure of trivial events to the stock exchanges, which was not really adding any value to the investors, but cluttering the information that was available to the investors. So, what happens is that too much of information also is not good, and information overload can actually result into a lot many vices that can happen. So SEBI has now introduced some sort of a threshold for disclosing fines or penalties. So if a fine or penalty is imposed by a sectoral regulator or an enforcement agency, then there is a separate threshold that has been prescribed. And if it is imposed by any other authority or a judicial body, then there is a separate fine or penalty that would be separate threshold that would determine the disclosure of these events. So if it is a sectoral regulator or enforcement agency, so let's first identify what would be a sectoral regulator or an enforcement agency. So what would happen for a NBFC? An NBFC is regulated by the RBI. So essentially the sectoral regulator would be the Reserve Bank of India. If there is an entity which is dealing in shares and securities, SEBI might become the sectoral regulator. However, for a listed entity into manufacturing, there may not be a directly applicable sectoral regulator in the meaning that we understand, because SEBI, though, is regulating listed entities, it is not the sectoral regulator for that entity. So what we understand to be sectoral regulator is typically the sector in which the entity is operating, and if there is a regulator for that sector, then that would be the sectoral regulator. If a fine or penalty is imposed by the sectoral regulator or the enforcement agency, then the same would require disclosure if the amount of this penalty or fine is 1 lakh rupee or more. If this is an amount which exceeds 1 lakh rupees, then an immediate disclosure is required to the stock exchange, which is that this disclosure will have to happen within 24 hours. If the sectoral regulator has levied a fine or a penalty, but it is below the threshold, then also a quarterly requirement has been introduced to put these items, that these are the list of fines or penalties levied on the listed entity during the quarter by the sectoral regulator or an enforcement agency. So that goes into the quarterly disclosure. The threshold that has been prescribed for other authority or judicial body is 10 lakh rupees. So what was 1 lakh rupee for sectoral regulator has been enhanced to 10 lakh rupees. If the fine or penalty is more than 10 lakh rupees, then it would require disclosure within 24 hours of that levy. If it is less than 10 lakh rupees, then it would be in the category of others. And in that category, you have a quarterly reporting requirement. So that would be sum and summary of the amendment relating to the manner in which fines or penalties have to be disclosed. And primarily, this is an outcome of the trivial disclosures that were being made historically by listed entities, which were not really material but were cluttering the information available to the investors. So, this is more in the nature of relaxation, and that's something that has been uh, introduced in the regulations through the amendments. Also, an amendment that has been carried out in fine or penalty is to have disclosures around the actions initiated. So at present, the disclosures have to also include the actions initiated, taken. So any regulator has initiated or taken any action, then both have to be reported. Now, initiated had a very wide interpretation, right? Like if there is any action which is initiated, how would a listed entity know which is one? Second is how and when would the listed entity understand that there has been some action initiated, because initiation of an action by regulator is not in their control. They can only know once the action is taken. So to remove this difficulty, the word initiated has been omitted from the disclosure requirement of fines and penalties. Tweak to acquisition disclosure threshold. So at present, the requirement for a listed entity to make a disclosure to the stock exchange in relation to acquisition gets triggered at a 5% threshold. So if a listed entity acquires more than 5% of any entity, it would trigger an acquisition disclosure, and the listed entity would have to make a disclosure of acquisition to the stock exchange in the prescribed format. And every movement of 2% beyond this holding was something that was required to be disclosed to the stock exchange. So if a listed entity would acquire 5%, then 7%, then 9%, each of these uh, milestones would require disclosure to the stock exchange that this is how the acquisition is moving. To reduce the level of compliance, this requirement of disclosing at a 5% threshold has been increased to a 20% threshold. Beyond the 20% threshold, incremental disclosure requirements at a gap of 2% has been reduced to 5%, has been increased to 5%. So from 20 to 22 would have been reported earlier. Now you need to report once you cross 25, then 30. So accordingly, there has been an amendment around the requirement to disclose this at the gaps of 5%. Additionally, quarterly reporting has been introduced for the gap between this. So any acquisition of shares more than 5%, less than 20% goes into the quarterly reporting. Any acquisition of shares changing by more than 2% from the previous reporting. So any acquisition of 5% or more or previous disclosure incremental of 2% or more will require a quarterly disclosure. Now, an interesting drafting amendment that has happened over here is something that is relating to the use of the word unlisted company. Now, when they have introduced the proviso for the quarterly reporting requirements, the interesting, anomaly is that they have used the word unlisted in company instead of company. So what happens is that when you are acquiring more than 5% or you are doing the check between the last disclosure and the holding at the end of the quarter, the gap has to be evaluated only for unlisted companies. It seems to be a drafting error. At present, how it is drafted, it only looks for unlisted companies. Typically, as such, it makes sense because for listed companies, the entity which is on the other side also would have to make disclosures. So that for that, it might have used the word unlisted company, but it seems to be a drafting error. The next amendment relates to disclosure of fraud by senior management. When this amendment came into being, the first thing was whether any fraud by the senior management was reportable. And the context to this was that if a senior management person has done a personal fraud, so let's say they have no connection with the listed entity, but in their personal capacity, they've made any fraud, then is this fraud something that is, reportable by the listed entity? In absence of clarity that it related to frauds done in connection or in relation to the listed entity, the common professional understanding of this drafting or the provision was that the fraud would require disclosure if it would have been done by the senior management. SEBI has clarified that it would only be required to be disclosed if it is in relation to the listed entity. Along with this amendment, they've also added that if there is a fraud done by the subsidiary of the listed entity, then that also has to be disclosed. So not only frauds by the listed entity or its senior management person, but also by its subsidiary, not by the senior management of the subsidiary, but by the subsidiary itself would have to be included in the list of includable disclosures of disclosable events. Arrest disclosure was already required. It is now, arrest disclosure has been expanded to include senior management and director. So earlier it was only promoter and promoter group. Now they have added the requirement of also covering directors. So even an independent director would be covered in the list of disclosable items when they are arrested. Also, the arrest disclosure has been expanded to include both, which is within India as well as outside India. So any of the arrests that happen within India or outside India, both are disclosable events. At present, there was only something that was understood within India to be a disclosable event. So to remove ambiguity, they have added this requirement. Per se, rather than removing ambiguity, because it's carried out through an amendment and not through an explanation, one can argue that earlier disclosure of arrest abroad was not required. However, now they've expanded the scope to also include disclosure of arrests of these category of people within or outside India. Definition of forensic audit. Again, there was a lot of discussion in the professional fraternity that would say that when and what types of audit have to be disclosed, because the term forensic audit is a term that has no definition per se. and it would mean any investigative review or any specialized engagement to review a specific sort of item, then that might lead to the requirement of disclosure for forensic audit. However, SEBI has introduced a definition of forensic audit for the purpose of disclosure, and it is confined to those audits that would require restatement of financial statements which has already been disclosed. So, if there is any revision to the financial statements disclosed by the listed entity, then that would require to be included in the forensic audit. Audits that do not require this may not be covered in the definition of forensic audit. It also illustratively gives a list of particular reviews or audits that have to be excluded from the list of disclosable items under the definition of forensic audit. So typically, product quality control practices, manufacturing practices, recruitment practices, supply chain process, including procurement, because generally in listed entities, what happens is that if there is a procurement, mismanagement or something kind of a review, and there are certain observations, the secretarial team would definitely want to understand the nuances of whether it would be covered under a forensic audit or not. And typically now with the clarification of it not being in the definition of forensic audit, this may not require the disclosure. Newspaper disclosure. So one of the important amendments that have been introduced is about the QR code instead of the entire financial statements. Now, the requirement to disclose the entire financial results quarterly basis in the newspaper is something that has been a requirement for listed entities, and every quarter they need to publish their financial results in a newspaper. While this was considered necessary earlier, the relevance itself has been diminishing primarily because any investor who wants to review the financial results of a listed entity primarily logs into either the website of the listed entity or any of the website of the stock exchanges and finds those disclosures. In the interest of people who still refer to newspapers for financial results, SEBI has continued the newspaper disclosure requirement, however, has modified the requirement to allow listed entities to publish only QR code instead of the entire financial results. The QR code should be of a link that contains the entire financial results. And on scanning the QR code, the investor or the reader can go to the web page where the financial results are posted. Along with this, SEBI has also made an enabling provision which allows for publishing the full financial results for those entities which find value in publishing those information. And so the requirement to print only the QR code is optional for the listed entity. Technically, do we continue to print the financial results along with the QR code? On reading the drafting of the regulation, it seems that if you publish the financial results fully, you may not be required to publish the QR code. However, as good corporate governance or a good practice of disclosure, you may want to comply with both if at all the management decides to continue publishing the full set of financial results. If full financial results are published, it's advisable also to publish the QR code along with that so that uh, it may be done. But and reading the drafting, it seems optional to publish the QR code if you publish the full financial results. When you go for a QR code disclosure, essentially you will have to disclose all the other relevant information about the name of the company and this QR code leading to the financial results for the period ended so and so. And that kind of a disclosure would be necessary even if you go for printing the QR code instead of the entire financial results. An interesting amendment around the time limit for disclosing the outcome of board meetings. So listed entities had a typical timeline of 30 minutes for disclosing events, primarily around financial results. So every quarter when the financial results are checked and looked at and approved by the board and the meeting concludes, There's 30 minutes from the time of meeting conclusion till the time it should hit the stock exchange with the disclosure. So to ease out certain requirements, because there are a lot of compliance requirements that follow pursuant to closure of the board meeting, especially with XBRL reporting, that it may not be necessary, it may not be possible to achieve that 30 minutes. But the amendment is uh, very interesting, I would say, because it is now linked with the trading hours. So if your board meeting concludes after trading hours, or 3 hours before the beginning of normal trading hours on the next day, which means that if your meeting concludes anytime between 3:31 p.m. and 6:14 a.m. on the other day, then you have 3 hours from the conclusion of the board meeting to have this disclosure, because that disclosure is not that urgent for anyone to take a trading call, because the trading hours are not going to be operational. But if your meeting concludes at 3:30 p.m., you have up to 4 p.m. to disclose, even though it is outside trading hours, but your meeting did not conclude outside trading hours. The disclosure timeline only is outside trading hours. So any disclosure requirement is amended only if your meeting concludes within this time period that has been displayed on the screen. Any other time period on a normal trading hour will have to be disclosed within 30 days. So the exception only is after the trading hours. So I think looking at the availability of the time limit for company secretaries to comply with, typically most meetings would now be planned in a manner that they get concluded after the trading hours. And that is how the advantage of this amendment might be taken by listed entities. Disclosure of claims against the company. So there is also a timeline that now mandates the disclosures of claims against the companies. Earlier, any litigation was to be disclosed within the time period of 24 hours. Now, claims under any litigation would have to go to the stock exchanges within 24 hours of them being known to the listed entity. There might have been problems for litigative matters where the quantification of the dispute itself is not available readily. Now, when the quantification itself is not available readily, the difficulty for listed entities was to meet this requirement of 24 hours of disclosure, because the calculation exercise itself would take longer. So, for giving ease about this entire thing, there has been an amendment that if the litigation relates to matters which are of tax, where the tax order itself has the amount of the claim, which is the demand, then that does not require any quantification, timeline or a time period for a person or the listed entity to quantify it. That can be disclosed, and that should be disclosed within 24 hours. For all other litigations or disputes, claims which arise out of those, you have 72 hours to disclose it, provided there is a condition that if the matter relates, which is an interpretation, they have the regulations only mention about the information being maintained in the segregated digital database of the listed entity of under the SEBI PIT regulations. But typically, if this is non-tax in matter or non-tax matter, then the listed entity has 72 hours for disclosing this event to the stock exchanges. However, the condition is for those to be under the SDD of PIT. That would typically cover only those matters which relate or are necessary to be maintained in the SDD. The 72-hour time window should also or would also be available for entities and other litigations which are not tax in nature, but which also do not require maintenance of the SDD for that. So tax disputes, claims arising out of that in 24 hours, other disputes in 72 hours, they need to be disclosed to the stock exchange. The next section of amendments that we would be covering would be related party transactions. So, related party transactions have been the cornerstone of corporate governance for listed entities, and that has been one of the most amended parts of the LODR since its introduction. The audit committee, as a role, has to also approve material transactions of subsidiaries or so any transaction for the subsidiary which is material in nature is also to go to the audit committee of the parent listed entity. That is one. The second amendment or the first amendment that we would be discussing right now is relating to the right of the audit committee or the power of the audit committee to ratify eligible RPT. And if we recollect, under the LODR regulations, the audit committee is required to provide a prior approval of all related party transactions of the listed entity. This is an enabling provision that allows the audit committee of the listed entity to ratify eligible transactions, which means that if there has been a miss of taking a prior approval of the audit committee, then this enabling power comes to the rescue of the listed entity where they can approach the audit committee to ratify a related party transaction. The eligible related party transaction is defined as transaction or transactions put together with one related party, not more than 1 crore. So if you have certain transactions that have happened with one related party, without prior approval, you may still ratify it with the audit committee provided all of them put together do not cross the limit of 1 crore. Secondly, this 1 crore is the higher limit, which means that if you have a lower materiality limit set by the audit committee for determining related party transactions materiality, that lower limit will prevail. So either 1 crore or the materiality terms that is agreed by the audit committee would be what would be the limit up to which transactions with 1 RP can be ratified by the audit committee. This is an enabling power. However, there's also an approval timeline that the audit committee has the power to ratify these eligible transactions only within 3 months of the related party transaction or the next audit committee meeting, whichever is earlier. So the power to ratify is also within a short time span. So they cannot look back historically to any missed related party transactions beyond this. The objective of making this amendment available to listed entities is that as we will go further into the definition of related party transactions and how there are changes made to it, there are events or possibilities that a listed entity may fail to realize that it has entered into a related party transaction, primarily because either the party was not identified as a related party or there was some kind of a transaction that happened in a large entity where it was not possible to track it to the related party and that RPT happened without the knowledge of the audit committee. So to ratify these transactions, there has been a power that has been given, but this power has limitation of time and amount. It cannot be ratified beyond the next audit committee after the transaction takes place or 3 months, whichever is earlier. And the amount itself cannot be more than 1 crore for all transactions put together for one RP or the materiality threshold, whichever is lower. So there's eligibility of the transaction. There's also a timeline to the approval or the ratification that is permitted. And with this, there is the power with the audit committee to ratify. Now, what happens if the audit committee cannot ratify it within the time limit or the amount is higher? One, the related party transaction becomes voidable at the option of the audit committee, which means that the audit committee has the power to void the transaction, but it does not have the power anymore to ratify the transaction. which means that the listed entity would be held as an entity in default of the compliance provisions, but the audit committee cannot now ratify it. Still, in spite of the listed entity being held as a entity in non-compliance with the applicable provisions, the audit committee retains the power to void the transaction, which means if there is a loss that is apparent to the audit committee, which is being suffered by the listed entity, they can void the transaction to which the approval was not sought. This is extra power that has been given to the audit committee. Also, the regulations now specify that if for such a transaction where a prior approval of the audit committee was missed, if the related party is that of a director of the company, or if any other director of the company authorized this transaction. In this situation, there is now indemnity which is provided in the law to be provided by the director or the directors involved, which means if the director whose related party it was with which the transaction took place, or the director who has approved, they will be liable for the loss that is suffered by the company on an indemnity basis, that they will stand to indemnify the company for the loss that they face. The other points relating to this amendment also include that the audit committee has to put forward, the audit committee has to be made aware about the rationale for missing this compliance, which means that the management of the company will have to put forward a rationale to the audit committee for missing the disclosure or taking the prior approval of the audit committee for the related party transaction. The second is when the transaction or the list of related parties has to be disclosed to the stock exchanges, there would also be the details of ratification that will be included in the disclosure statement. So the ratification of the entire list of transactions which have been ratified will also have to be disclosed along with the list of RPT, and the audit committee is empowered to put more conditions for seeking its ratification, which means that the audit committee has the power to put more conditions on the listed entities management to seek its ratification of related party transactions. The second amendment relates to the power of the audit committee to grant omnibus approval for RPT of its subsidiary. Now, audit committee of listed entity is required to approve RPT of subsidiary which are material in nature. So once this requirement was there, there was no authority with the audit committee to grant omnibus approval for RPTs of the subsidiary. Though audit committee had the authority to grant omnibus approval for related party transactions of the listed entity, there was no authority to grant such omnibus approval for subsidiary. It has now been extended that even the audit committee of the listed entity will have powers to grant omnibus approval for transactions or RPT of subsidiary which has to be referred to it. So this is an enabling provision for the audit committee, expanding its powers. This is a very clarificatory. I think it's kind of the amendments that we'll now discuss will give you the tone about the intent of the regulator around the related party transactions, because there are now certain amendments which are very granular in nature, like corporate actions. If the drafting of the regulation was to be seen, it said that any corporate actions which are commonly applicable to all the shareholders, including the related parties, would be excluded from the compliance requirements of the related party transactions. This would typically include dividend, bonus, all these kinds of corporate actions, which would, impact every shareholder. These were outside the ambit of related party transactions, but only when they related to the listed entity, which means any corporate action of the listed entity was excluded from RPT. Any corporate action of the subsidiary entity was not excluded from the definition of RPT, and it necessarily needed compliance of RPT. Now, I am reasonably surprised because most of the secretarial teams of listed entities would have never applied their mind to read the law with such granularity that a dividend declaration which applies to all shareholders, the exemption from it being an RPT was only available to listed entity and not to its subsidiary. There is now an amendment to provide that it also includes corporate actions commonly applicable to all, even for the subsidiary of the listed entity. So only now has it been excluded, which means that the law is trying to be very granular at all levels. So up till now, the requirement of getting audit committee approval for even corporate actions of subsidiary was applicable. Certain transactions, now these amendments make it very interesting. Currently, for listed entities where there are banks, current account deposits and saving account deposits, as well as interest on payment of fixed deposit. This is now added to the list of excluded transactions from the list of RPTU, meaning thereby that so far till date, the regulator intends to say that these kind of deposits were included in the definition of related party transactions. Primarily because earlier the exception only was for fixed deposits. So the banks which are listed, which maintain bank accounts, and if there are promoters, directors, now essentially a director of a bank is expected to maintain the bank account with the same listed entity, right? Like a director of bank one will not be looked up well, and for the even the financial health of the bank, if that person maintains a bank account with another bank, it would not be very conducive for the business interests of the bank if such a thing happens. However, looking at how RPTs are structured for banks or for these kind of transactions, where current account deposits and saving account deposits are now excluded, meaning they were included before, casts a very granular definition of these things where acceptance of fixed deposits was considered as an exempt. Payment of interest on those fixed deposit was not excluded. They are only excluded now with this amendment. So this kind of a granular definition of RPT makes it very, very cumbersome for the listed entity, because now we have to interpret the regulation in a manner that what is written is only exempted. What is not written, even though it may be very illogical to understand that such a transaction can also be an RPT, will have to be looked at through the lens of a specific exemption available. If there is no specific exemption available, then the requirement would be to take it to the audit committee, either get a prior approval or now with the ratification provision, take a ratification of the audit committee within the timeline and for the amounts which are prescribed. Secondly, retail purchases are now excluded. So any purchases are which are made from the listed entity. Let's say a listed entity operates a retail store, and a director of the company goes to the retail store and makes a purchase. Before this amendment, the intent of the regulator seems that those transactions were covered as a related party transaction. Now the cashier on the store would never know that the person is a director, and those transactions would happen in the normal course of business at arm's length without the secretarial team of the company ever going to know about it. But if the director has made a payment through the credit card and it is tracked later on that this was the person who bought it and this was a related party transaction, that would have triggered a compliance requirement. So for this, they have excluded retail purchases, but also clarified that it would only apply where a business relationship is not established. They have not gone on to define what a business relationship is, but typically the intent seems that any regular course of such transactions, such as anything which is of a dealership or a distributorship nature, that may not be covered within this ambit. But typically, what we understand as retail purchase is commonly applicable to all, should be outside the definition of RPT. Interestingly, fixed deposits which were accepted by listed entities had to be reported in the statement of related party transactions that is being filed with the stock exchanges. These two exceptions, which have now been introduced, have also been excluded from that disclosure, which means that even though current account deposit, saving account deposit, or interest payment on fixed deposits, this would not even be reportable as RPT in that statement. So, the bigger risk that these amendments pose is the granularity at which these amendments are being made. Kind of communicating the intent of the regulator that if these regulations are so rigid, so stringent, compliance would be even more necessary because the interpretation would definitely and necessarily be limited to what is written and not what is understood. So, listed entities would have to be very careful in defining their RPT policies and also putting in place controls to check that RPTs do not move out of the definitions and are tracked with proper accuracy. Certain things have been moved from the requirement of the audit committee approval for, so let's say, sitting fees of directors and remuneration below the materiality threshold for subsidiary. So if a subsidiary's RPT is being made these payments of sitting fees and remuneration, they are now not necessary to be approved by the audit committee of the listed entity. There is an optionality of disclosure. So sitting fees which are paid to directors and remuneration which is paid to the key management personnel, these are now optional to be disclosed in the statement of RPT which needs to be filed with the stock exchanges. So this exception is only available if the party is not a party belonging to the promoter or promoter group, and if the transaction is not material as per the materiality threshold. So materiality threshold plays an important role for all these compliances. If any transaction is beyond the materiality level set by the audit committee, it would necessarily warrant disclosure. However, if also if it is for a promoter entity or a promoter group, the sitting fees and directors paid to any person belonging to that group, that would also warrant a disclosure irrespective of the amount involved. Selling, disposing, and leasing of assets by listed entity, there was this requirement of disclosing if the disposal was more than 20% of the overall assets of the material subsidiary. The exception now provides that if the transaction is between two wholly owned subsidiaries, then this requirement would not apply. The related parties, the related party transactions which involved government on one hand. Now, it's interesting to note that payment of fees or other statutory payments made to the government was also included as a related party transaction for government sector companies. So to remove that difficulty, there is now an amendment that provides that, this kind of transactions where government has control on an entity and that entity is making payment of any statutory fees, that would not be considered as a related party transactions. Again, going very granular on the definition of related party transactions, specifically now the interpretation guidance would definitely be what is written is only accepted, or that's the only exception. What is not written is always a related party transaction. Vacancy of independent director was required to be filled up before the vacation of office if that vacation of office would result into the board composition not being in compliance with the requirements of regulation 17(1). Let's say if the person whose office is the term is expiring, that term would expire and would result into the board composition not being in compliance, which means that the ratio of independent directors to the non-independent directors might not be in compliance with that vacation. Then it was necessary for that vacancy to be filled up before the expiry of the term, so that at any time, which means that when the vacancy happens, the board composition remains in compliance with the regulatory requirements. Similarly, there are requirements of the audit committee, the NRC, the stakeholder relationship committee, the risk management committee. All of these committees have composition requirements, including certain committees requiring that the chairperson should be an independent director or composition dependent on the overall structure. Now, the vacancy that is going to be caused by expiry of term, if that vacancy results into non-compliance of composition requirements, including chairpersonship of any of these committees, including the audit committee, NRC, SRC, or RMC, they would necessarily require that independent director's vacancy to be filled before the vacancy actually happens. So that is something that needs to be now taken care of. So not only the composition of the board, but any subcommittee or committee composition also would necessarily require a prior filling before the vacancy actually happens. Special business matters. So under Companies Act, general meetings have business, ordinary business and special business. For items where special business is there, there needs to be an explanatory statement. Along with the explanatory statement, there was a necessary requirement for listed entities to also give the recommendation of the board for each item of special business. Now, along with the recommendation, the board also has to give the rationale for the recommendation, which means that now, for all matters of special business, there should not only be an explanatory statement, there should also be the recommendation followed with the rationale of the board for recommending the decision that they want or are recommending to the shareholders. The approval of shareholders, special resolution required for any director continuing beyond 75 years. The regulations now require that this approval will have to be taken at the time of appointment itself if the term covers the age of 75. So if a person is being appointed at 72 for a term of 5 years, then at the time of appointment, it is known that the term can result into the director being 75 and require special resolution at the time when he crosses the bridge of 75. If at 72 the director is being appointed, then at the time of his appointment at the age of 72, a special resolution would be required, which would suffice for the resolution to work even at the time when he crosses the milestone of 75 years of age. Approval of shareholders was necessary for any director appointment within 3 months or the next general meeting, whichever was earlier. There were certain entities where there would be a regulatory approval that would be necessary for appointment of a director. Chances were that these regulatory approvals they themselves were not in place within that timeline of 3 months. So to do away with that difficulty, the time period taken for getting regulatory approval would not be considered in the time limit of 3 months. Additionally, this requirement of taking shareholder approval within 3 months would not apply for any directors which are nominated by a financial sector regulator, court, or a tribunal. So, for nominee directors appointed by these entities or agencies, the requirement to take shareholder approval within 3 months would not apply. Certain recommendatory changes around directors, boards, and committees. Women independent director are required for the top 1,000 entities by market capitalization. SEBI has now made it recommendatory for entities falling from 1,001 to 2,000 to have one woman ID on their boards. Interestingly, a meeting of independent directors has been recommended where no person from the management nor any person who is a non-independent director on the board of the company. Other than these people, the independent directors should meet twice a year and they should discuss about the company. This has been made recommendatory for each of the top 2,000 listed entities. So it is mandatory at present for none, optional for the top 2,000. Optional meaning recommendatory for the top 2,000. RMC also has been made recommendatory for 1001 to 2000 companies, which is by market capitalization. And the compliance requirement, if they opt for it, is recommended to be in lines with the RMC requirements for what applies to the top 1000 companies also. Other changes are that 4 times meeting in a year has been changed to 4 times meeting in a financial year. I think that's just a technical change. 120 days between board meetings, they had to clarify that it meant consecutive board meetings, which was naturally understood by everybody. But looking at the granularity of definition of the regulations, they have gone on to specify consecutive. Approval of non-executive director remuneration, if it crossed 50% of total remuneration, also every financial year, this is now an additional requirement that is required to be taken. Integrated compliance reporting. So there are certain reports that go out every quarter, and those reports are intended to be consolidated into one single integrated report, and that would come in its due course, and that would take the replacement of the existing reporting requirements for listed entities. This would be a very important change for listed entities, where this integrated compliance reporting can save a lot of effort for various separate filings. Plus, if we currently log into any stock exchange website and find any listed entities, there are a whole lot of disclosures and an information overload. So analysts and investors kind of have to declutter that information for relevance. And this integrated reporting can help in achieving that sort of uh, declutter that is necessary for meaningful disclosures. Compliance officer. So essentially at present, practically what happens is generally the company secretary, which is designated as the KMP of the company, they typically occupy the compliance officer position for listed entities. Now, listed entities are required to appoint qualified company secretary as a compliance officer. Now, there are certain additional requirements. One, they have to compulsory be in full-time employment. So if any of the listed entities have a part-time employee CS, or I don't know how, but if there is any consultant role company secretary, that may not work. Some entities might have entered into a consultant role with a company secretary for their taxation advantage, but that also will not be permitted going forward. The company secretary has to be in full-time employment. The company secretary has to be one level below the board. They can't be below one level below the board. So they have to be just below the board, and they have to be designated as KMP. So the compliance officer has to meet these requirements going forward. Full-time employment being one of the most important amendment that might impact listed entities. Also, one level below the board, designated as KMP. Technically, practically, most of the CS that are designated as KMP only work as the compliance officer. So that may not have that impact, but in the intent of clarity, they've also mentioned the same. Secretarial audit is one more amendment that has come into uh, a rotation requirement. So secretarial audit was already applicable to listed entities. However, rotation was not applicable to these firm or proprietors that were doing secretarial audit of listed entities. So for listed entities, the LODR has now contained the rotation requirements, where the secretarial audit firm, if they are an individual, they can have one term of 5 years, 5 years cooling period, and then they can be reappointed. So the provisions are exactly similar to how statutory auditors work. If that's a firm, they get two terms of 5 years, 5 year cooling period, and they can be reappointed thereafter. However, the term of 5 years, because the appointment itself now will be instead of annual to 5 years. The second thing would be that the 5 years will not be in any way not allowing the listed entity to remove the secretarial auditor with approval of its shareholders, or the right of the secretarial auditor to resign. So technically, that is something that needs to be borne in mind. The interesting amendment here is that they have not done anything like the Companies Act, that for the first time of this applicability, you get 3 years or anything. This apply from 1st of April 2025, which means that the annual general meeting that you conduct in 2025 would have to take up as an agenda item the appointment of the secretarial auditor. The appointment would be for 5 years, and the period of past association will not be considered, which means your existing secretarial auditor, irrespective of them being an individual or a firm, can continue. The only requirement now is that the LODR regulations also require the firm or the individual to be a peer reviewed firm. Secondly, similar provisions as for statutory audit, common partners are not allowed within the firms when you apply for, when you look at the rotation provisions. Any vacancy will have to be filled in within 3 months, and will hold office till conclusion of next AGM. Recommendation of board of directors. Now, this is an interesting drafting again, because typically any audit related work should go to the audit committee, right? Now, instead of that, what is the requirement in the LODR is that the approval is required from shareholders in AGM, and the board will recommend the same to the shareholders. Now, there's no mention about how the secretarial audit requirement should flow through the audit committee. So that is something that is interesting to note. But as a matter of good corporate governance, it should always be routed through the audit committee, because it relates to secretarial audit, and there's an audit committee in the company. So that should be the way in which it should go in the normal course of operations of the listed entity. In the notice of the annual general meeting, the terms of appointment and recommendation basis has to be provided, and this compliance is necessary from 25-26, which means 1st April 2025. Website disclosures. Now, these provisions have come into effect from 12th of December 2024. So when we are discussing it today, it's already 18 odd days that these regulations have been in force, and listed entities are necessarily required to disclose articles of association, memorandum of association on their website. They are now also required to disclose brief profile of every member of the board of director, along with the list of their directorships and full-time positions in body corporates. So this is also additionally required to be disclosed on the websites of the listed entities. The websites of the listed entities have to disclose investor meeting presentations before the beginning of such events. Detailed disclosure requirement has been cast in terms of employee benefit scheme documents. The listed entity has to disclose on their website employee benefit scheme documents along with entire disclosure. The exception only is if it leads to a competitive position that can be affected by such disclosure, or commercial secrets that can be impacted with such disclosure. Then and then only can these things be redacted. They cannot be stopped from disclosure on these grounds. The employee benefit scheme documents have to be disclosed. They can only be redacted if they give away commercial secrets or can affect the competitive position. However, this decision of redacting these documents before disclosing on the website has to be approved by the board of director. Now, it's very interesting. This already is now in force from the 12th of December. Many companies already have employee benefit scheme documents. If they want to redact any part of that, they need to call for a board meeting. The board has to decide on the redaction, because it has to be in compliance with the applicable guidelines. SEBI has not yet specified these guidelines. So at present, how this disclosure should or would work practically is something, but for listed entities, those who have employee benefit scheme documents and those do not leak any commercial secrets, or if such information cannot affect them competitively, then they are required to disclose the employee benefit scheme documents on the website. Now, would this mean ESOPs only, or would this mean any benefits that are given to the employees? They have not defined very well about it. Technically, it means any employee benefit scheme that goes for the listed entity has to be disclosed on the website of the listed entity. Hosting requirements on the website. Now, because they are adding to the list of disclosures that have to be made on the website of the listed entity, there are two things. The regulator also wants disclosures to the stock exchanges, and the regulator also wants the listed entity to host all the information on their own website. This results into duplicate hosting, means there are two places on the internet where the same information is hosted. So SEBI, understanding this, has given an option that on the website of the listed entity can choose not to host the same material again, but they can only disclose the web link of the stock exchange, the exact web link where this information is available, and that would be deemed compliance to this requirement of hosting information on their website. So duplicate hosting is something that has been avoided. Timeline for hosting and retention for audio video recording of calls. The hosting period is 2 years, which means that has to be on the website for 2 years, and thereafter retained by the listed entity as per its retention policy for a period not less than 8 years. So you can take it down from the website after 2 years, but you have to retain it for 8 years. For transcripts, you have to host it on the website for 5 years. You can take it down after 5 years, but still hold it as per your retention archival policy, not less than 8 years. Certain disclosures have been removed from the annual reports. Stock code, market price data, high low during each month in last financial year. So this information typically not much relevant to be disclosed in the annual report. So the same has been removed from the list of disclosures that are to be done in the annual report. Next relates to corporate governance. Listed company, there are certain people within the listed company like KMP directors, promoter group. All of them are responsible for ensuring that the listed company complies with the LODR regulations, and this requirement is cast by Regulation 5. Till date, there was nothing to say that the listed entity would have any documented support from these personnel. Now it gives the requirement to get the following class of people: KMP directors, promoter group, to disclose to the listed entity all information that is relevant and necessary for the listed entity to ensure compliance with the applicable law. Which means there were certain provisions that meant or were necessary for listed entity to comply with, but its compliance would only be if these people disclose it to the listed entity. In absence of a regulatory power for or a regulatory responsibility cast on these people, there might have been chances that these people would not disclose it to the listed entity, and the listed entity would be deemed to be in default. To avoid this, there is now a requirement that these people or personnel have to necessarily disclose things to the listed entity. Corporate governance provisions apply currently on the basis of net worth or equity share capital being below the threshold for 3 consecutive years for them to not apply. So, if an entity is covered under corporate governance provisions, if it has to move out of the corporate governance provisions applicability from the LODR, the entire section, it has to be less net worth than threshold, less paid up share capital than threshold, either of the two for 3 years, then it would have been outside. However, the intent was not either, it was both, which means that if you have raised more capital but you have eroded the net worth, then also you continue to comply with the provisions of the LODR, which means that capital and net worth both being less than the threshold will only trigger inapplicability. Once applicable, they would remain applicable so long as any of the two remains above the threshold. Physical documents to shareholders. Currently, the LODR states that for those shareholders who do not have their email registered with the listed entity, hard copy of statement containing salient features of all documents was required to be sent to the shareholders. Now, the requirement has been loosened and it mentions a letter providing the web link, including the exact path where the complete details of the annual report is available. So this is a significant change for those shareholders who do not have their emails registered, and easing out compliance for the listed entity also. Then annual reports to shareholders were required under the LODR to be sent 21 days before the AGM. This has been done away with. Only notice of AGM is now required to be sent to the shareholders. Proxy forms were required to be sent for every general meeting. Now, considering that most of the meetings happen in electronic mode, it is not necessary for the proxy forms to go out. So, for general meetings which are held only in electronic mode, there is now no longer a requirement to send proxy forms to the shareholders. There are certain amendments around the CIRP related provisions. So, when a listed entity goes into the corporate insolvency resolution process, the entire board is suspended. Various compliances go for a toss. There's deconstitution of various committees, etc., because the insolvency resolution profession comes into the control and manages the affairs of the listed entity. However, once the resolution plan is passed and all these offices are reinstated, the compliance requirements have to be redone and have to get back on track. So to provide for that timeline, the regulations now mention that any vacancy in the office of the company secretary, CEO, managing director, whole-time director, or manager or CFO, or the composition of the board of directors, or also the composition of the committees, the audit committee, NRC, SRC, RMC, all of this needs to be done within 3 months from the approval of the resolution plan. So once the resolution plan is approved, they need to be in compliance of all of this within 3 months. For financial results, there are disclosure requirements. So for quarters other than the last quarter, once the resolution plan is approved, they have to be done within 90 days. For entities which are equity listed, the requirement is to do it within 45 days for every quarter other than the last quarter. In the last quarter, for normal entities, it is 60 days. For CIRP resolved entities, it is 120 days from the end of the quarter, the last quarter. Certain amendments for entities having non-convertible securities listed on the stock exchanges. So XBRL reporting has been extended to even those entities that have non-convertible securities, typically high value debt listed entities. They will also now be required to disclose all of their compliance requirements in XBRL format. Quarterly financial results. Earlier for these entities, the quarterly financial results were only to be taken on record by the board of directors. Now the same has been replaced with getting approved by the board of directors, and also the results should be signed by either the chairperson or the MD or the full-time director of the company. Moving to the other section of our coverage, the definition has been introduced for SR equity shares, which is the superior rights equity shares. There were certain provisions where SR equity shares were referred to, but they were not defined. So now the amendment brings in the definition of SR equity shares, which is having superior voting rights compared to all other equity shares issued by that listed entity, removing the requirement of compliance certificate with respect to registrar and transfer agent. Erstwhile, Regulation 7 bracket 3 required a listed entity to submit a compliance certificate for complying with the requirement of the share transfer agent, and it was to be signed not only by the compliance officer but also by the representative of the RTA, and it would have to be done within 30 days of the end of the financial year. Now, either this will be integrated into the integrated report or it has been done away with considering the specific prevalence of stock exchanges handling the securities and the entire system of intermediaries that come into play. However, once the notification for that compliance comes up, we'll have more clarity around this. Material subsidiary definition. Uh, Currently, material subsidiary meant a subsidiary whose turnover or net worth income or net worth exceeded 10% of consolidated income or net worth. So there were interpretational issues as to whether income meant gross or net, what level. So now the regulations have specified that income has to be replaced with turnover. So it would now mean that a material subsidiary would be looked at the turnover or the net worth level. Largely, most listed entities were classifying on the gross income basis only, so there would not be much impact around this. Nonetheless, if at all there has been any listed entity which is doing it on a net income basis, then they may have to relook into the definition of material subsidiary and its reclassification and compliance requirements for appointing independent director on the board or any other requirement that can come up basis this reclassification. Another requirement or amendment has been in the requirement of compliance around reclassification of promoter and promoter group. The reclassification earlier required the approval of the stock exchanges. Now that requirement has been modified to seek a no objection letter from the stock exchanges. There have been prescribed timelines, 30 days if that is received within 30 days. Otherwise, it will be deemed to be received subject to there not being any query raised by the stock exchange. So kind of somewhat easing out the requirement of getting this reclassification. Shareholder requests, again, all the shareholder requests such as subdivision, split, consolidation, renewal, exchanges, endorsements, etc., were required to be settled by issuance of a certificate by the listed entity. This requirement has been changed by issuing a letter of confirmation instead of a certificate by the listed entity. Disclosure requirement to the stock exchange has been eased out for the loss of share certificate. If you open any listed entities the web disclosure page, you would typically find that there is a lot of disclosure around this loss of share certificate. So to remove that clutter, the intimation to stock exchanges has been done away with for both intimation for loss as well as for issuance of duplicate certificates. Record date compliance, advance notice of 7 working days, excluding the date of intimation and the record date was earlier required to intimate a record date. This has been now reduced to 3 working days, which means record date can be in total 5 days away from the date of disclosure. Also, time gap between two record dates was earlier required to be at 30 days, which has now been reduced to 5 working days, which means 7 days from the date of the disclosure because it has to exclude both the date of intimation and the record date. We have kept some 10 minutes for question and answers, if any. What are our concluding thoughts? So you can post your question and answers in the QA section. We'll have a look at it. Additionally, the points that we wanted to share with you right now as concluding thoughts basis our analysis was one that granular regulations can definitely lead to a lot of rigidity in interpretation. The way in which related party transactions have now been defined, the way in which there are clarifications for deemed understood matters. It just shows on the regulator's intent, how they want this to be a very strictly interpreted set of regulations. And with that strictness comes a very difficult situation that if you have a transaction that gets covered within that ambit, then there would be a significant impact that can, lead you non-compliant to these regulations and subject to penal provisions. Secondly, though SEBI follows the consultation route, it has already shared these thoughts in the public. The implementation came immediately on a particular date, like the 12th of December. These rules and these regulations came into force. Certain provisions like website disclosures and other things are still not compliant with for various listed entities, and sufficient time for implementing these provisions is something that can be thought of being given to the listed entities. At least a 2 week time for such changes is something that is plausible and can be considered. These changes require a lot of updates to SOPs and checklists. So at many places, you need these changes to happen, which for listed entities, you'll have to ensure that it, uh, you know, gets updated and all the trackers and checklists get updated to reflect compliance with these regulations. Interestingly, in our analysis, though we have analyzed 84 amendments, we have only covered 58 in our analysis and the presentation right here. To all the attendees who are attending, we will be sharing a copy of this slide deck as a token of gratitude for you taking out your time and joining us today. For those who are interested to refer to the entire spreadsheet containing the list of the entire analysis and also a list of actionable items that follow, please feel free to write to us at services@kpcindia.com and we'll share that spreadsheet with you on a on-demand basis. At this juncture, I would like to thank you and express our gratitude for joining us today and sharing all your thoughts.